But let's discuss what took place within the Chinese market. Yesterday, the Chinese stock market suffered one of its biggest falls this year before staging a massive recovery. It has been the riskiest and the most volatile markets in 2015 for sure. Mark Matthews of Bank Julius Baer joins in. In fact, he's written a note on how the Chinese market could do from here. Mark, hi, good morning. I was looking at your thoughts on China, where you say that the economy, the Chinese economy as a whole, is looking better. However, the equities are vulnerable to any hints of stricter regulations to reduce speculation. Do you think, given that there could be, some regulations put into place to reduce the speculation in the Chinese market, investors would avoid China for now, at least in the near term?
I don't think so, because there's another big thing, which is that MSCI on June 9 will announce whether they're going to include the A shares in their emerging market index or not. And what we can see looking at the fund flows is that foreigners have been buying a lot of the H shares. Those are the Chinese stocks listed in Hong Kong, I think probably in anticipation of a positive soundbite from MSCI. Now, the problem is, and I don't want to get too nitty-gritty, Shenzhen, which is the big city in China near Hong Kong, is 30% of A-share market cap. And right now, there is not a Shenzhen-Hong Kong Connect program the way there is a Shanghai-Hong Kong Connect program. Therefore, I don't think MSCI can fully include the A-share market on June 9, because 30% of it is not accessible. But what they can say is they're doing something provisionary, and that's important.
Okay. So would that mean that there will be, less weightage for other shares, so we should expect some outflows from India as well?
It will mean that the weighting for other countries will go down. Whether that precipitates an outflow, I sort of doubt it, actually. When we look at MSCI rebalancing in the past, well, I mean, over the long term, I would expect, as China becomes a more significant part of the emerging market index, and I mean, if you just look at it broadly, it should probably be about 15%. Then the other ones, in relative terms, will become less significant, but that doesn't necessarily mean their stock markets are going to go down.
Okay. This is an interesting point, because our previous speaker, Jitendra Shriram, also pointed out the exact same thing, that this MSCI announcing its decision on June 9th to include A shares in its emerging market index will cause a lot of flows to move into some of these H shares going ahead. What kind of fund flows do you think foreign investors would pump into the Chinese markets in the near term, and how would that impact a market like India?
Well, there's so many dynamics at work in the Chinese market now. So you mentioned already that the economy will probably start to pick up in the second quarter. That's a good thing. I would add there's been a significant amount of monetary loosening, which should continue. They are removing a lot of the kind of, how should I say, the systemic risk that people were concerned about with the local government debt, with the property market, those sort of scary things that you would have seen on television, ghost cities and shadow banking. All of that is sort of reducing in risk. But on the opposite side, what we do have, and you also mentioned it, is because the market's gone up so much, when the government does announce that it wants to reduce speculation in the stock market, we get these kind of panic sell-offs like we had yesterday. But yesterday the market rebounded and it closed up almost 1%. So that's sort of the way I think it's going to be going forward. The market will be going up. I think it's a bull market, but it's also kind of a hairy asset, if you know what I mean. It's going to jump around a lot.
Okay. Well, there's one contradiction which still comes, which still perhaps remains unexplained. The Chinese economy is slowing, and yet it is a bull market, a sustainable bull market.
Well, you raise a very valid point, and the fact is that if we look back at data, and I've analyzed this there's no correlation between GDP growth and stock market performance in any country.
Okay.
What moves share prices is the cash flow that those companies generate. And therefore, what I like to tell people is look at China as if it was a company. And by the way, I would say exactly the same thing with India. If a company gets new management, and that new management is good, that will impact the cost base. That will impact the quality of the product and service that the company sells, and therefore its competitiveness, and therefore its cash flow and the amount of profit that it generates. China has new management, essentially, new leadership, and they're good, and they're executing. And that's why the stock market's going up.
So finally then, you've written in your key message that China is a volatile market, but one worth owning. What about India?
I think it's a similar story. I mean, as I said, if you just kind of look at it as a company instead of a country, I believe it will become better run, and therefore the cash flows will increase. But, it's also similar to China in the sense that I remember when the new leadership came in China, that was in, in 2012. In 2012 and 2013, there were all kinds of worries about this new leadership and its ability to execute. And when they did start reforming, and you saw, some slowdown in certain aspects of the economy, and people were very worried about, they're hurting the economy. And now India looks so very similar. People are worried about the slowdown in the rural economy in India as the government gradually reforms. But if we can look past that, and China has proven market's ability to look past that, I see a bright future, and I don't see the need to sell Indian shares.
All right, that's nice to hear, Mark. Thank you very much for joining us this morning.
Thank you.